The market is bleeding and fear is at its peak. Retail investors are selling in panic, headlines scream collapse, and social media is flooded with doomsday predictions. But behind this chaos lies a pattern that has repeated in every major crypto cycle, the final shakeout before the boom. This is the phase where the majority give up. The same people who bought Bitcoin at $60,000 are now selling it below $30,000, believing it's going to zero. What they don't understand is that the market is designed to test conviction. Prices crash not just because of market forces, but because the system wants to flush out the weak hands, those who lack patience, knowledge, or belief in the underlying technology. Every cycle before Bitcoin's major rally, there's a brutal crash. In 2018, Bitcoin dropped to $3,000. In 2020, during the COVID panic, it touched $4,000. Each time, the crash was followed by a surge that broke all previous records. This phase is no different. Long-term holders aren't moving their coins. On-chain data shows accumulation is still happening. The whales are not panicking. They are buying. This is the moment when narratives shift. Mainstream media calls it a dead asset. Influencers disappear. But seasoned investors know that when sentiment is this negative, the reversal is near. Fear is not a sign to run. It's a signal to watch closely. Watch closely. Volume is drying up, volatility is increasing, and weak altcoins are dying. These are not signs of death. These are signs of cleansing. The market is preparing for something bigger, something historic. The shakeout is nearly complete, and what comes next is a phase of recovery, followed by euphoria. This has always been the cycle. In every financial market, the crowd is almost always wrong at extremes. When everyone is bullish, it's time to be cautious. When everyone is bearish, it's time to prepare. This is not financial advice, but a warning. The final shakeout is often the last chance to position wisely before exponential growth begins. Panic now, and you may watch the next boom from the sidelines. Stay focused, study the data, and understand the cycle. The boom doesn't warn before it starts, it just happens. While retail investors sell in fear, institutions are executing a different strategy. They're quietly buying the dip. This isn't speculation. It's visible through on-chain data, exchange flows, and institutional investment reports. Wallets holding large amounts of Bitcoin, especially those with over 1,000 BTC, are steadily increasing. These wallets aren't owned by average traders. They belong to corporations, hedge funds, and high-net-worth investors. During times of fear and market collapse, these players accumulate. They understand the structure of market cycles. Retail panics when prices drop, but institutions view these drops as entry points. Every crash brings discounted prices for assets with long-term potential. Bitcoin is not just a digital currency anymore. It's becoming a macroeconomic asset, increasingly treated like digital gold. BlackRock, Fidelity, and other financial giants have already filed for spot Bitcoin ETF. These filings aren't casual. They represent a calculated move to dominate the next wave of crypto adoption. Institutions operate on long-term timeframes. They don't chase pumps, they prepare for future value. When the crowd is distracted by daily volatility, institutions quietly restructure their portfolios to benefit from the next major uptrend. Stablecoin inflows into exchanges are also rising, a key sign that buying power is being positioned. OTC desks are reporting higher volumes, which usually signals large-scale private transactions away from public exchanges. These are not the actions of panic traders. These are strategic moves by entities with capital, data, and patience. The market is emotional, but institutions are not. They don't follow hype, they follow metrics. Supply issuance, having timelines, inflation trends, and liquidity cycles. They see Bitcoin as a scarce asset in an increasingly inflationary world. With over 90% of all Bitcoin already mined, supply shocks are inevitable when demand returns. Every dip they accumulate is a future asset under management. Every crash they survive is a deeper moat they build against competition. While social media declares the death of crypto, the smartest money in the world is entering the space with precision. This isn't just a coincidence. This is a playbook. In past cycles, institutional involvement came after the boom. This time, they're ahead of the curve. While fear drives many out of the market, institutions are buying what they know the world will chase later, and they're doing it silently. Global macroeconomic triggers are forming a perfect storm. positioning Bitcoin for a potential breakout. Central banks around the world are reaching a tipping point. After years of aggressive rate hikes to combat inflation, major economies like the United States are signaling a shift. Interest rates are approaching unsustainable levels. Debt servicing is becoming a burden. A pivot is not a matter of if but a when. Once rates start to drop, liquidity will return to the market, and historically, Bitcoin thrives when cheap money re-enters the system. At the same time, inflation remains a persistent threat. Despite government reports suggesting it's under control, prices of essentials continue to rise globally. In this environment, hard assets gain appeal. Bitcoin, with its fixed supply of 21 million, stands out as a hedge. Gold has traditionally held this role, but Bitcoin offers portability, transparency, and decentralization, qualities the new generation of investors prefers. Geopolitical instability is adding fuel to the fire. Conflicts across regions are weakening trust in fiat currencies. Countries facing sanctions or political risk are exploring alternative reserves. Bitcoin's borderless nature makes it a serious option. Data shows rising adoption in emerging markets and politically unstable regions. The worse the global outlook, the stronger the case for decentralized financial tools. Currency devaluations are accelerating. The Japanese yen, Turkish lira, Argentine peso, and other national currencies are losing value rapidly. People in these economies are seeking ways to preserve their wealth. Bitcoin is becoming that exit route. It's no longer a niche investment. It's becoming insurance against systemic collapse. Meanwhile, institutions are preparing. With spot ETF applications pending approval and governments defining clearer crypto regulations, the foundation for mass adoption is quietly being laid. Traditional finance is integrating crypto, not rejecting. This alignment of global economic trends, monetary easing, inflation, political tension, currency risk, and institutional readiness is rare. These macro forces don't trigger overnight rallies. They build quietly, then explode into momentum. Bitcoin's price doesn't just move from hype, it moves from pressure, supply squeeze, and narrative shifts. Every trigger is falling into place. This alignment is not speculation. It's visible in the data. Bitcoin is being positioned not just as a digital currency, but as a macro asset ready to rise when the world begins to crack. Bitcoin's halving countdown has officially begun, and the clock is ticking toward one of the most powerful events in its economic model. Approximately every 4 years, the Bitcoin network undergoes a halving, a scheduled reduction in the block reward miners receive. The next halving will cut the current reward from 6.25 BTC to 3.125 BTC per block. This simple change cuts the new supply entering the market in half, instantly making Bitcoin more scarce. Historically, halvings have triggered massive bull runs. In 2012, Bitcoin surged from under $10 to over $1,000. In 2016, it climbed from $400 to nearly $20,000. After the 2020 halving, it skyrocketed from $8,000 to over $69,000. The pattern isn't random, it's economic pressure. When supply drops and demand remains constant or increases, price must adjust upward. Miners play a crucial role. After the halving, their profitability drops unless the price rises. This forces inefficient miners to exit, reducing network selling pressure. At the same time, remaining miners become more selective about selling their limited rewards. This constrains available supply even further. Retail interest always spikes after the halving, but institutions are preparing in advance. They know that by the time mainstream attention returns, prices will already be higher. This time, unlike previous cycles, the halving is aligning with broader macroeconomic pressures, inflation concerns, weakening fiat currencies, and growing global interest in decentralized assets. With over 93% of all Bitcoins already mined, the upcoming halving won't just reduce new supply. It will highlight Bitcoin's long-term scarcity. There will never be more than 21 million Bitcoins. As more investors and institutions realize the fixed nature of this asset, demand can outpace supply dramatically. Exchange reserves are also near historic lows, meaning fewer coins are available for purchase. With halving set to further tighten this supply, any increase in demand could result in an aggressive upward move. Unlike traditional assets, Bitcoin's issuance schedule is transparent, predictable, and immutable. The halving is not just a technical event, it's a built-in trigger for exponential scarcity. Every day that passes brings the halving closer. Every block mined reduces the time left until supply pressure intensifies. It's not hype, it's math, code, and economics working together. The countdown is more than a timer, it's a fuse.